Hello, this is Kirill from forexboat.com and welcome to the course on Forex trading. In today's tutorial, we will answer the question, what is Forex and where it came from? Forex stands for foreign exchange. It is also sometimes abbreviated as simply FX. Investopedia defines foreign exchange as the exchange of one currency for another or the conversion of one currency into another currency. So simply put, foreign exchange is the exchange of currencies. Also, Investopedia continues this definition by saying that foreign exchange also refers to the global market where currencies are traded virtually around the clock. So let's have a look at an example. Say, for instance, you're going on a holiday to Europe. In that case, you will take your American dollars and go to the exchange shop and convert them into euros. By doing this, you've conducted a currency exchange and therefore you have become a participant of the Forex market. We will talk about the participants of Forex more in one of the future tutorials, but today let's have a look at the history of how this used to be back in the day, because it wasn't always as easy. So here's a timeline. And a long time ago, there was no money, no currencies, and people had to just exchange goods. And this was called barter. When some people would fish and other people would grow grains and crops, they would exchange some of their goods in order to have the best of both worlds. Next, around 2600 BC, Egyptians discovered gold. We're not really sure who discovered gold and when, but it's attributed to Egyptians around that time. People liked gold very much because it was very dense and it felt very heavy in your hands, and it felt more valuable than other things around. It was shiny and it was soft, so you could mold it into different shapes, and most importantly, it was very scarce. It was very hard to find, and that also increased its value. Next, around 1500 BC, gold was used, or countries started using gold for international trade. So instead of just exchanging goods, they would exchange gold for goods and goods for gold, and that kind of simplified things. Then, to simplify things even further, around 700 BC, the first gold coins were created, and that was a very handy thing to have, because before that, people had to check that the gold that they're receiving is actually gold, and also they had to weigh it up. But by having gold coins, they could already know what value those gold coins are carrying, and that speeded up the process of exchange. So that's a bit of ancient history, which now brings us to the modern world. In about the 17th century, paper money started spreading across Europe, and around the 18th century it became so popular that it started causing tensions, because some people and countries were still using gold and silver coins, whereas others were actively using paper money, and there was no real connection between the two. And that is when the gold standard came into play. The gold standard was agreed upon in 1875, and basically what it meant was that currencies became backed by gold reserve of their countries. In essence, that means governments guaranteed conversion of currency into a specific amount of gold and vice versa. Let's look at an example. For instance, country A says that its one unit of its currency equals 2 ounces of gold, and country B says that 1 unit of its currency equals to 4 ounces of gold. And that basically means that you now know how to convert currency of country A into currency of country B. That made things more simple, and also defined certain rules around how these transactions occurred. And the gold standard became the first standardized means of exchange in history. So that was a good idea in general, but then what happened was World War I struck and World War II. During these wars, countries that were fighting with Germany spent a lot of money on their military, and basically they were printing more and more money, and which they had to back by gold reserves, and the gold reserves were rapidly depleting, and it got to a point when they couldn't actually guarantee all that money with gold, and therefore the gold standard lost its meaning. And so to fix that issue, in 1944, the Allies got together to sign the Bretton Woods Agreement. And Bretton Woods Agreement, simply put, it's just the same as the gold standard version 2.0, and all it did was it replaced gold with the US dollar, and the US dollar became the only currency in the world that had to be backed by gold at a fixed exchange rate of $35 per ounce, and all other currencies had a fixed exchange rate to the US dollar. So let's have a look at a bit more detail into the outcomes of the Bretton Woods Agreement. So first of all, fixed exchange rates. All currencies were pegged to the US dollar. Second, the US dollar became the primary reserve currency, which meant that it had to be backed by gold. And three, the creation of two organizations. The International Monetary Fund, which is simply a pool of funds where all participating nations contribute to on a regular basis, and then if they have problems within their country, they can take money out of that pool, fix their problems, and then return it, plus pay some interest. And also the World Bank, which is a financial institution of the United Nations, meaning that its main purpose is to reduce poverty around the world and help developing countries. By the way, if you're wondering why it's called the Bretton Woods Agreement, that's because it was signed in a town called Bretton Woods in New Hampshire, USA. And as you can expect, when you create something which is basically the gold standard version 2.0, then there's a very high likelihood of it failing just as the gold standard did. And that's exactly what happened to the Bretton Woods Agreement. Over the years after World War II, gold reserves of the US started depleting very rapidly, and in 1971, US President Richard Nixon closed the gold window by telling all other countries that the US will no longer exchange gold for US dollars held in foreign reserves. This event marked the end of the Bretton Woods Agreement, and since then the world has been using floating exchange rates between currencies, what we now know as the Forex market. The main two takeaways from this timeline are that, first of all, it hasn't always been that simple. It took some time for nations to come up with the current Forex system that we have. And secondly, that there have been several attempts at creating fixed exchange rates between currencies. For example, the gold standard and the Bretton Woods Agreement. And all of these events have failed because it is very artificial to put such constraints on currencies and try to control them. It also illustrates that the Forex market that we currently have is by far the most natural thing that should govern the exchange rates of currencies between each other. This brings us to the end of today's tutorial. I hope you enjoyed it, and I look forward to seeing you next time. Until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on Forex trading. Today we will talk about the Forex market participants. So here's the Forex market, and who are the major players here? Well, first of all, of course, it's governments. Governments use the Forex market to meet certain economic goals, whether it's to have a lower exchange rate compared to a certain currency or a higher exchange rate. It all depends on whether the country is importing or exporting goods, and many various other factors. Also, the central bank. In most cases, the central bank is the financial arm of the government, but sometimes the central bank is more independent for some countries, and the central bank also uses the Forex market to move around its reserve of currency and monitor the situation and things like inflation, interest rates, and so on. Next, we've got normal banks. Normal banks trade on the Forex market to define which exchange rates should govern the exchange of currencies. And those, like when you and I, we go to a bank and we do exchanges there or do certain transactions, those transactions are minuscule compared to what banks deal at an international level. They throw around billions, if not trillions of dollars just to make sure that they have the right currencies that they need for their activities. Also, other financial institutions participate in the Forex market, and an example of that would be the pension funds in the US. They are massive companies who have lots and lots of money, and sometimes they need to make transactions on the Forex market as well. Other players on the Forex market include normal companies such as BMW, Coca-Cola, General Motors, and any other multinational company that you can think of. And that's because these companies have operations across the globe, and therefore they are forced to convert currencies all the time in order to pay suppliers, pay employees, and so on. For example, Coca-Cola might be paying some employees that it has somewhere in India and would have to convert dollars into rupees. Or, for instance, BMW might be ordering some parts from Japan, and that way they have to convert euro into yen and pay for those parts. Another good example is when BMW might order the parts from Japan and get them, but they only have to pay for them in 1 year. So in that situation, they have two options. They can either create the product, sell it, and then 1 year later pay for the parts, but then they will have to convert euros into yens 1 year later, and the price of yens might have gone up by then, and that will mean that BMW will lose on this foreign exchange transaction, and this loss will eat into its profits from the normal operations. So in those cases, most companies do something which is called a hedge, and what they do is they instead of waiting 1 year to convert their euros into yens, they will actually create a forward contract with a bank saying that they will need yens in 1 year, and they will create a fix or agree on a fixed price now with that bank, but to buy those yens 1 year from now. That activity is called hedging, and therefore these companies are sometimes referred to as hedgers. So these are instances when they don't need to buy the other currency immediately, but when they will need it later on, and so they're called hedgers because they're hedging themselves or protecting themselves from this foreign exchange risk. And actually a lot of companies across the globe undertake this activity. Another type of major players on the forex market is hedge funds. Hedge funds are actually funds that are, or organizations that are designed to speculate on the forex market and bring profits to their investors. So even though they're called hedge funds, they're mostly well, now they've kind of developed to become very aggressive and profit seeking. So they take on large funds from investors, and then they try to trade this money on the forex market to make profits, and they earn fees, and plus they earn commissions if they do create profits. And finally, the normal traders such as you and I and George Soros, just people who speculate on the forex market to make a profit. So they're also participants of the forex market, and for example, George Soros was able to make over $1 billion of profit in 1 month. That's one of the reasons why what he's famous for. So all those participants together, as you can imagine, create massive volumes of money. And to be more precise, the volume of the forex market is $5 trillion. That is 5 and all those zeros behind it, and that is per day. $5 trillion goes through the forex market. That's an unbelievable amount of money. And just to put that into comparison, the largest stock exchange in the world is the New York Stock Exchange, and the total market capitalization of the New York Stock Exchange, that means if you take all the companies that are listed on the New York Stock Exchange and you put all of their values together, then you will get only $18.7 trillion. And that's the total capitalization of that exchange. Whereas on the forex market, you have $5 trillion going through the market per day. And that just shows that the forex market is by far the biggest financial market in the world. So that sums it up for today. I look forward to seeing you on the next tutorial, and until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on forex trading. Today's going to be a very fun tutorial. We're going to talk about forex charts. Very often when you hear about forex charts, you hear the abbreviation OHLC. So what does it even stand for, and what does it mean? OHLC stands for open, high, low, and close. And to get to know this abbreviation a bit better, we're going to start by drawing two axes. The horizontal axis will be time, and the vertical axis will be price. Now, these four blue lines each one of them represents the start of a new day on our timeline. So right now on our chart we have 3 days: day 1, day 2, and day 3. Now let's for a second forget about day 1 and day 3 and just focus on day 2. We're going to use this chart to represent how the price of a certain currency pair changed through time. So let's assume, for instance, that we're looking at the euro-US dollar currency pair. When day 2 started, this currency pair already had a certain price. So at midnight of day 2, there was a certain price. Let's mark this price with a simple dash at the correct price level. Also, when the day finished, at midnight between day 2 and day 3, the euro-US dollar currency pair also had a price. Let's mark that as well. So the first dash, the one on the left, is called the open price because the day 2, opened with that price. And the second dash, the one on the right, is called the close price because day 2 closed with that price. And also throughout day 2, the price naturally moved up and down, and somewhere there was a minimum price of that day. So let's mark that minimum price with an X. On the other hand, there was also a maximum price throughout the day. Let's mark that one with an X as well. If we now connect the X's with a vertical bar and forget about the X's themselves, then we have now created a complete bar for the euro-US dollar currency pair for that day, for day 2. And as we saw through the creation process, any bar has 4 price points. The open price, which is the dash on the left, the low price, which is the bottom of the vertical bar, the high price, which is the top of the vertical bar, and the close price, which is the dash on the right. So to quickly sum up, every bar has an open, a low, a high, and a close price. And that's where the abbreviation OHLC comes from. Now if we put multiple of these bars together, then we will get a Forex bar chart. As you can see, the closing price of one day is actually the opening price of the next day. There are some exceptions to this rule, especially if you're looking at Friday and Monday, because something might have happened over the weekend and the opening price on Monday might be different to the closing price on Friday. But generally speaking, in most cases, bars flow on from each other. Now sometimes these bar charts can be colored into red and green rather than just black to help traders see right away which bars are going down and which bars are going up. Bars that are going down are called bearish bars, and bars that are going up are called bullish bars. But we'll talk more about bears and bulls in one of the upcoming tutorials. Now this is a bar chart. In Forex there are actually 2 more other types of charts that are very popular with traders. So the next type of chart, and perhaps you've even heard about this one, but if you haven't, doesn't matter, is called a candle chart. And I'm just going to transition this bar chart into a candle chart and watch how this transition happens. In front of us we have the same chart, but now it looks different. Instead of vertical bars and horizontal dashes, we've got these rectangles with lines sticking out of them at the top, at the bottom, and some of the rectangles are hollow and some of them are filled. In essence, this chart carries the same information, it's just visually represented differently. First thing that we can notice is that because of these vertical lines, some of the rectangles actually do look like candles, and that's why it's called a candle chart. Now every one of these candles has 3 elements to it. It's got a body and it's got 2 shadows. Sometimes the shadows are also called tails. The shadows are very easy to understand because they're the same as what we had with a bar chart. The top of the top shadow represents the maximum price or the high price, and the bottom of the bottom shadow represents the minimum price or the low price. The body is a bit trickier than with the bar chart. The bottom of the body can represent either the open price or the close price, and the top of the body can represent either the close price or the open price as well. So how do you understand which one is which? Well, there's a general convention that hollow candles are bullish candles, meaning the ones going up, and filled candles are the ones that are going down, or bearish candles. And here hollow means the same color as the background. Filled means a different color. The way to remember this is that hollow are lighter than filled because filled have more paint in them or color. They're heavier, so they're going down, and the hollow ones are lighter, so they're going up. That's the way I personally remember it. So knowing whether a candle is going up or down, it's very easy to understand where the open price is and where the close price is. This is because for a bullish candle, the bottom edge will always be the open price and the top edge will be the close price, whereas for a bearish candle, the top edge will be the open price and the bottom edge will be the close price. Also, candle charts can sometimes be colored, just as we saw with bar charts, and that helps traders see patterns quicker. In this case, red means bearish candles, green means bullish candles. And finally, this brings us to the last type of Forex chart, which is a line chart. A line chart basically simplifies this whole process by representing only one single price. It only represents the close price. So instead of looking at open, high, low, and close, the line chart will only look at the close price. So if we now take the close prices of every single day and we connect them, then we'll get a line chart. As you can see, it's much simpler. It carries less information, but sometimes it can be very convenient to make rough estimations and see overall patterns, and then further after this analysis go into more detail. Now let's have a look at a couple of real Forex charts. Here is the Euro-US dollar daily line chart. So as you can see, this is just what we talked about, only the close prices for every single day. At the bottom you can see the days, on the right you can see the prices, but most importantly we can see the line chart, which is showing us that currently the Euro-US dollar seems to be falling down. Now let's look at the same chart but represented by a bar chart. As you can see, now we have much more information. They might be a bit more cluttered, but we can see where the highs and lows were and exactly how this progression or this trend is developing. And now I'll change this bar chart into a candle chart, and you should decide for yourself which one you like more. So there's a candle chart. The filled bars are the bearish bars, the hollow bars are the bullish bars, and it's actually a matter of personal preference whether you like the bar charts or the candle charts more. Some people use candle charts, some people use bar charts. It all depends which one is visually more plausible to you. And finally, I wanted to show you the same bar chart but in a different color scheme, because we will be working with MetaTrader 4, and you'll notice that by default the color scheme is different. It is green on black. So I'm just going to transform this now, and as you can see here, this is the typical MetaTrader 4 bar chart. It's got a black background and it's got black and white bars. This might be a bit confusing at first because here the black bars are bullish and the white bars are bearish, as opposed to what we had on the previous slide. But the way to remember is not black and white, but hollow and filled. In this case, the background of the chart is black, so hollow will be black, and therefore the bullish bars are black in this instance. And whereas white is the opposite of black, and therefore the bearish bars are white and they're filled with color in this case. And before we finish off this tutorial, I'd like to mention that Forex charts are available not only at the daily level, but at many different time frames. So you could have 1 minute charts, you can have 10-minute charts, you can have 15-minute charts, 30-minute charts, weekly charts, monthly charts, and you can actually have any kind of chart in between because there are special tools to create those charts for you. But we'll go into more detail on this in further tutorials, and you'll see how we naturally will work with 15-minute time frames and hourly time frames. All of the concepts stay the same. On that note, we'll wrap up today's tutorial. Thank you very much for your attention, and I look forward to seeing you next time. Until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on Forex trading. In today's tutorial, we will talk about currency pairs and how to read them. So let's have a look at a chart. This is the Euro-Dollar daily chart, and you can see that the current price for the Euro-US dollar is 1.2524. So what does that mean, and how do we understand that? Well, let's look at the currency pair at the bottom. The currency on the left of the pair is called the base currency. In this case, it's the euro. And the currency on the right is called the quoted currency. In this case, it's the US dollar. You may see this price of 1.2524 for the euros dollar currency pair written the following way. This is equivalent to writing it out as euro/US dollar equals 1.2524. Now let's quickly simplify this example to understand it a bit better. Let's replace the euro currency with apples. And let's say that we're quoting the price of apples in US dollars. Personally, I really like this approach because it takes one of the unknowns out of the equation. If you think about it, euros, like any other money, is a tangible object. You can hold it in your hands, you can measure it, you can weigh it up, you can count it. It's something that actually physically exists. So that means we can easily replace it with something else that also physically exists, but is better known to us, like apples, for example. You can count apples, you can weigh them up, and you can hold them in your hands just like euros. So there's no harm in replacing euros with apples just for the sake of this example. So here you can see that a price of a single apple in American dollars is 1.2524, and that's exactly what this equation means. And now if we go back to the euro, we can quickly understand that the chart in fact represents the price of one single euro in terms of US dollars. So this means that at the point in time when the snapshot was taken, for 1 euro you would get 1.2524 US dollars. And conversely, to buy 1 euro you would need 1.2524 US dollars. And this principle applies to any currency pair. The chart simply expresses the value of the base currency, which is on the left, quoted in terms of the quoted currency, which is on the right. So as more candles appear throughout the day and the price changes on your chart, you always know that this is simply the price of the base currency changing in terms of the quoted currency. Now let's look at another example. Let's take US dollar, Canadian dollar for instance. And this example will be a bit more tricky because the US dollar is on the left. Now as you can see, the US dollar is the base currency in this example, and the Canadian dollar is the quoted currency. How do we read this chart? Very similar approach. US dollar Canadian equals 1.1287. It's the same as putting a slash in between the currencies. And now we can replace the US dollar with apples. As you can see here, we're replacing the base currency with an apple. And it doesn't matter that it's the US dollar. There's nothing special about the US dollar in terms of Forex charts. The US dollar can be on the left, the US dollar can be on the right. It doesn't matter. What we're looking to do right now is we're looking to replace the base currency with something that we know quite well, in this case apples. So in this example we can see that the price of one apple is 1.1287 Canadian dollars, or approximately 1 Canadian dollar and 13 cents. So now going back to US dollars, we can see that the price of 1 US dollar is approximately 1.13 Canadian dollars. This means that for 1 US dollar you will get 1 Canadian dollar and 13 Canadian cents, or conversely, to buy 1 US dollar you would need 1 Canadian dollar and 13 Canadian cents. And now when we look at the chart, we know that the price is simply telling us how much an American dollar is worth in Canadian dollars. And as the price goes up and down throughout the day, that's simply the price of American dollars expressed in Canadian dollars, also changing throughout the day. There are over 180 currencies in the world, and you can combine any two of them to give you a currency pair. Most traders identify two main groups of currency pairs, and these are the majors: the euro US dollar, the dollar yen, the British pound dollar, the Australian dollar American dollar, the dollar Swiss franc, and the dollar Canadian dollar. And also the second group is the crosses. Crosses are simply put all currency pairs that do not include the American dollar, such as the euro British pound yen, Australian dollar Canadian dollar, and so on. And of course there are also all other currency pairs. One more final note before we finish today's tutorial is that the order in which two currencies go into their currency pair is fixed. So for instance, you will never see a currency pair called US dollar euro or a currency pair called US dollar Australian dollar. That's because it has historically developed in each case how the currency pair is fixed, and people just choose not to change it so in order to avoid confusion. So a euro US dollar chart will always be a euro US dollar chart, and therefore you will always know that it is quoting the price of 1 euro in terms of American dollars. On that note, we will wrap up today's tutorial. I look forward to seeing you next time, and until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on Forex trading. In today's tutorial, we will talk about bulls and bears and buying and selling on the Forex market. Perhaps by now you've already heard about the two creatures that dominate the Forex market, and these are the bulls and the bears. So the bulls stand for Forex traders who invest in the growth of a currency pair. Here we've got an example of the British pound dollar in an upward trend, and in this case the bulls would be active and they would be buying this currency pair, and then in order to close it later and profit from the growth in price. And in a minute we'll discuss the mechanics behind that. Bears are people who invest in the decline of a currency pair, and this is an example of the euro US dollar in a downward trend. Here the bears would profit from selling this currency pair. The terms bulls and bears have a historical background, and they were first introduced a long time ago in the stock market. The choice of animals has quite a lot to do with the way they attack. A bull would fling up its opponent into the air, and that is similar to how currency pairs move upwards. A bear would generally attack by using its paws to drag somebody down, and that's similar to how currency pairs move downwards. There is a bit of a difference between the Forex market and the stock market, and that is because the stock market, the way it's formed, people associate bears with kind of negativity or a pessimistic approach. Since the bears are selling, and when you sell a stock you think that the company is going to underperform, it's going to fail, and you want to short sell that stock, and we'll talk about short selling in one of the future tutorials. But generally that's a pessimistic kind of approach, whereas bulls are happy creatures that are aggressive, that look forward to something growing and becoming more valuable, like a stock for example. But on the Forex market that is very different. Bulls is still the same, they're looking for something to grow. Bears are not pessimistic. Bears just invest in the decline of a currency, but there is no actual company behind this currency. It's not a stock. So by investing in the decline of the euro US dollar, you're just saying that the euro will drop but the US dollar will grow. So in a way you're actually investing into the growth of the US dollar. So that's something to remember, that bears are not bad. Anybody can be a bear, and moreover most traders will sometimes be a bull and sometimes be a bear. So you can buy in one case and sell in another case depending on what your analysis tells you, and we will talk more about that in the Forex analysis section of this course. Alright, moving on. Today we will talk about bulls and buying on the Forex market. Let's look at a British pound dollar example. And here we can see an upward trend. Let's assume that a bull trader bought at that point in time marked by the cross, and the transaction was conducted at a quoted price of 1.4400 for the British pound US dollar currency pair. As we recall from one of the previous tutorials, this means that at that point in time every single British pound was worth 1 American dollar and 44 American cents. Then let's assume that the trader waited for some time and closed his transaction at the price marked by the second cross, and the quoted price at the time was 1.5950. So this bull trader knows what he's doing, and he made money through this transaction on the Forex market. let's understand how exactly that happened. Let's look at the mechanics behind it. So let's assume that the bullish trader had 1,000 US dollars to invest, which he put into the British pound at a quoted price of 1.4400. Now, as we did previously, let's simplify this example by replacing the British pound with apples, because apples are also tangible. We can hold them, count them, measure them, weigh them up, and we can always replace the base currency with apples to simplify things. So now our example says that the trader had $1,000 which he invested into apples at the price of $1.44 per apple. This means that he bought 694 apples. Next, he waited a certain number of days until the price for apples grew to $1.5950 per apple. And at this point in time, he still has 694 apples. What he did with these apples next is he sold them at the new price, and in return he got $1,107. So as you can see, he started with $1,000 and now he has $1,107. So if we break this final amount up, we can see that $1,000 is the starting amount on his account, and $107 is the profit that he made. Now moving back to the British pound, we can see that nothing changes if we replace apples back with the British pound. The trader invested $1,000 into the British pound. He got 694 pounds. Then he sold them at a higher price, got $1,107 back, and that is his profit, $107. So he got his 1,000 back, and he's got $107 extra on top of that. So in Forex, the first transaction is called buying. The second transaction is called closing. So even though he actually sells the British pound for dollars, because this is the second part of a buying transaction, or this whole one integral transaction, it is in Forex we call it closing rather than selling, so that we don't confuse things. So you open transaction by buying and then you close that transaction. So these are the mechanics behind a bullish transaction on the Forex market. In the next tutorial, we will talk about short selling on the Forex market and the mechanics behind that. And further down the track in this course, in one of the tutorials, we will talk about leverage, and I will show you how this trader could have made much more profit using leverage, even with the same starting deposit of $1,000. Thank you for your attention today. I look forward to seeing you next time, and until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on Forex trading. In today's tutorial, we will discuss in great detail the topic of short selling. Many traders, especially beginners on the Forex market, find short selling rather confusing, and that is why I will specifically try to walk in your shoes today and be as explicit as I can when talking about short selling. So let's jump straight into it. As we've already established, there are two types of traders on the Forex market: bulls, traders who invest into the growth of a Forex currency, and bears who invest into the decline of a Forex currency. So today we're talking about short selling, and that is applicable to bears. Let's look at our Euro US dollar example in more detail. So here's a chart, and how would a bearish type of trader profit from this downward trend? Well, there's a trend, and a bearish trader would enter somewhere over there where we see the X on the top left. He would sell at about 1.3140, and as we recall, that means that every 1 euro is worth 1.3140 US dollars, and then he would close the transaction at about 1.2480, meaning that in that point in time, every euro is worth only 1.2480 US dollars. So as we did previously, let's simplify this example by talking about apples, and now let's look at the mechanics of how all of this comes together. Well, first of all, we don't have apples. We know that on our account we have American dollars, but we don't have apples. How can we sell something that we don't have? So how does that work? Well, this is why this transaction is called not just selling, but the proper name for it is short selling. It's because you are selling something that you don't actually own. And the way it works in the Forex market is you as a trader, you approach your broker. And all of this is done automatically, so you don't have to think about it at all. But this is what happens in the background when you click that sell button in your trading platform. So you as a broker, you as a trader approach your broker and you borrow apples from your broker. So let's say, for instance, you borrowed 500 apples. The amount of apples you can borrow is underpinned by the actual amount of money you have on your account, because you have to guarantee that you will return these apples no matter what. So you borrow 500 apples from your broker, and you then take these apples to the Forex market and you sell them at $1.3140 per apple, and that gives you in return 657 US dollars. So now you have that money and you decide to hold on to this 657 US dollars because you've predicted that the price of 4 apples will drop, and you wait for that to happen as per our chart which we looked at earlier. So once the price for apples drops and it hits about 1.2480 American dollars per apple, guess what? You still have those $657 that you got in exchange for your apples a couple of days or weeks earlier. So what are you going to do with these $657 now? Well, you're going to go and you're going to buy back apples. Now with your $657, you can buy 526 apples. So as you remember, you still have to return 500 apples to your broker, and that's exactly what you do. You return 500 to the broker, and that means you still have 26 apples of profit in your hands. Because of this transaction, you're left with an extra 26 apples. And now what you do with these 26 apples is you convert them back into US dollars at the exchange rate at the time. And that basically means that now you have a profit of 32 US dollars. Now, if we replace apples with euros as we did previously, you will see that nothing changes. That this whole scheme works also for euros just as it did for apples. You go to your broker, you borrow 500 euros, you sell them at 1.3140 for 657 US dollars. You hold on to your 657 US dollars until the price for euros drops. You use those $657 to buy back euros at the new lower price of 1.2480. You get 526 euros in return. You return 500 euros to your broker. Your profit is 26 euros. Because your account is in US dollars, you convert your euros back into US dollars and you have 32 US dollars of profit. So that's in a nutshell how short selling works. You may find slightly varying explanations for the stock market, and that's because you're dealing with stocks and ownership rights to a company. But in the Forex market, these are actual transactions with actual money, and this is how short selling works on the Forex market. Also, as we discussed previously, the first transaction over there is called selling. It's short for short selling, but and everybody is so used to just saying selling on the Forex market that they no longer use the combination of where it's short selling. So we'll just stick to selling from now on. And the last transaction over there is called closings. So as you can see, it's not that complicated. The concept itself is a bit different to buying, but the Forex market has been around for so long, and the procedures in place in any brokerage company are so standardized that you will not even see a difference. The mechanics are different, but the way you conduct a buy transaction is identical to the way you conduct a sell transaction. And the way these things work in the background, they don't even charge an extra commission for borrowing those 500 euros. And finally, before we finish today's tutorial, I would like to point out that just as with buying, with selling, you can use leverage to achieve much better results from your trades. And this is something that we will discuss in the future tutorial when we talk more about leverage. And thank you for your attention. I look forward to seeing you next time. Until then, happy trading. Hello, this is Kirill from forexboat.com and welcome back to the course on Forex trading. In today's tutorial, we will talk about Forex brokers and we will understand why we actually need them in our day-to-day trading. So if we imagine the Forex market, then it's got lots of different participants, such as major banks, central banks of governments, investment banks and investment companies, other normal companies that need to conduct foreign exchange transactions. And these are all the major players of the foreign exchange market, and they constantly transact with each other, and they always transact in very, very large amounts of money. We're talking billions of dollars here. And so together they comprise the Forex market. So how does a person such as you and me get into this Forex market? Even if we have a deposit on our account of $50,000, and more likely than not it's often less than that. Even with such a large deposit, it's hard to get into a market where an average transaction is several billion dollars, and the daily volume is measured in trillions of dollars. So how can we get it there? And that's where the broker comes into play. A person such as you and me will go to a broker, and the broker will also work with a lot of other people, individual traders who will also go to this broker. And the broker will then aggregate all these transactions and send them to a bank. So a broker has an established relationship with a bank, and because it can scale up all of these little transactions that all the clients of the broker conduct, then the bank is more willing now to work with the broker. There are many different types of brokers and different types of relationships between the broker and the bank, and they include market maker brokers, STP brokers, ECN brokers, and so on. However, at the end of the day, the concept remains the same. A single individual person cannot gain access to the Forex market and has nobody to transact with. But a broker can facilitate access to the foreign exchange market to each one of us by scaling up our transactions. Over the past decade, brokerage services have become very competitive, and there are lots and lots of brokers out there. And this makes it very important to select the right broker for your trading. And if you're new to the foreign exchange market, I recommend checking out my review, which I did a couple of weeks ago on my website. So in this review, I compare the top 3 brokers that I've ever worked with in my 7+ years of foreign exchange experience. You can see here that it says best Forex brokers for algo trading, and that's because my trading is predominantly comprised of algorithmic trading systems and Forex robots. However, this review can help you select a broker even for manual trading, because only one of the brokers I talk about is dedicated solely to algorithmic trading, and the other 2 you can both use Forex robots in them, or you can trade manually, and I've tried and tested them, and they are reliable. So if you want to check out this review, just go to www.forexboat.com/brokers, and when you read this review, you will notice that for each one of these brokers, I specify exactly how many funds I have held with them at the maximum, and how much money I have withdrawn, and how they have gone about processing those withdrawal requests. And so this serves as proof of their trustworthiness. I'm pretty sure that this review will be worth your while, because it will help you avoid the natural mistake most beginners make when they select an unreliable broker who basically trades against them and makes them lose because of that. On that note, I'm going to finish today's tutorial. Thank you for your attention, and I look forward to seeing you next time. Until then, happy trading. Hello, this is Kirill from forexboat.com, and welcome back to the course on Forex trading. In today's tutorial, we will talk about Forex market hours. We will see in which time zones the Forex market operates and how it so happens that the Forex market is so different to any stock market in the way that it works 24 hours a day. For this tutorial, I really wanted to show you a global map of the world with the Forex sessions visualized on it. And because I couldn't find a decent one on the net, I went ahead and made one of my own. And this is what it looks like. And I'll definitely share it with you by giving you the link to download it at the end of this tutorial. So on this map at the bottom, we've got a time axis, and the way to read it is from right to left, because the sun rises from east to west. That axis is in GMT time. And then we've got the four main Forex sessions, starting from bottom to top as they commence through a new day. So the first one is a Sydney session, then it's a Tokyo session, then it's a London session, and then it's the New York session. So what can we see from this visualization of the Forex market hours, and how can we use this in our trading? Let's have a closer look at the sessions one by one and see what exactly happens over a 24-hour period on the Forex market. So the Australian session. You will notice that the very first session to open during any given day is the Sydney Forex market session. And Australians are the first nation to wake up into a new day. It's still 22 hours, so 10 p.m. of the previous day in London when Sydney banks open up. So this means that if you live in Europe or in the US and it's Tuesday, then you can already trade the Wednesday Sydney Forex market session. And that's just a mind-blowing fact that I was very interested to learn when I first got into Forex. Also, you may ask, what about the New Zealand session? And that's a fair point. New Zealand is located even more to the right from Australia, and the New Zealand session starts about 2 hours before the Sydney session. However, without the Australian session, the liquidity on the New Zealand market is very low, and so that's why people focus on the Sydney session rather than the New Zealand session. Moving on, the next session is the Tokyo session, which follows shortly after. This session is also called the Asian session because right after Tokyo, large economic hubs like Singapore and Hong Kong start waking up. The Asian session starts around midnight GMT when most of Europe is still in a deep sleep. And this is why you often hear European traders talking about waking up at 3 a.m. just to trade the Asian session before going back to bed. Also, you may have already noticed that some of the Forex sessions overlap quite significantly. For example, the Australian session and Asian sessions overlap for the majority of their Forex market hours. And the good news is that you can use this knowledge to your advantage. Naturally, when these two sessions overlap, currency pairs like the Australian dollar Japanese yen and the New Zealand dollar Japanese yen will have their highest volatility. The next session that follows the Tokyo session is the London session. Undoubtedly, London is the economic center of Europe, and it's essential that the European session is also called the London session. Moreover, by the time banks open up in Great Britain, other major economic hubs like Frankfurt, Luxembourg, and Zurich have already started into their Forex market hours for the day. An interesting observation is that the Forex hours of the Tokyo and London sessions overlap for approximately 1 hour, and this varies a little bit for other European countries. And you can, and you probably should use this fact to your advantage. This slight overlap means that all of the crosses of European currencies and the Japanese yen will have their highest volatility at the start of the European session. So if you're trading the British pound Japanese yen, for instance, you can simply carry out a few very powerful trades between 8 a.m. and 9 a.m. GMT, and then you're free for the day. And some traders actually do that. They capitalize on this narrow window of time when both sessions are open. They take the most out of the movements of volatile currency pairs like the British pound Japanese yen, and then they finish their trading very early on in the day, and they have the rest of the day for themselves. And finally, the last session to open up is the New York session. Forex market hours in the US start with New York, and this is because New York is one of the biggest financial centers in the world, and it is the eastmost major city in America. The American session also includes other major economic hubs like Chicago, which is the world's largest derivative market, and let's not forget about Toronto, which is a major Canadian financial hub. So what happens when you put more firewood into a fire? That's right, it burns even harder. And same thing happens here. New York and London are the two of the world's biggest financial centers, and the American session starts when the European session is only halfway through. And of course, you're going to get an extremely fast-paced and volatile market during that overlap. And once again, you can profit from this. A lot of the major pairs like the euro dollar, pound dollar, and the dollar Swiss franc experience massive movements and specific patterns during this time. In fact, I created a holistic trading strategy for the British pound dollar just based on this one fact. The strategy is called Simple System version 6.0, and you can find it in my Forex Robots course. It uses an extremely profitable pattern that I discovered for the British pound dollar, and in that course I give it away for you for free. So if you're interested, definitely check out that course. And finally, to sum up the Forex market hours, let's have a look at the end of the New York session. As you can see, even though the Sydney session and the New York session do not overlap, they follow each other back to back. And this illustrates why the Forex market is open 24 hours a day. If you take any time zone on this map, at least one Forex session will always be open. And in the end, I'd like to say that whatever your trading strategy is, it is always beneficial to keep in mind the Forex market hours of the 4 Forex sessions. This is because different sessions are dominated by different types of traders, banks, governments, and as we discussed, different types of currency pairs. And taking this into account will certainly give you a competitive advantage over other Forex traders. So that brings us to the end of today's tutorial. As promised, here's the link to this map. Just go to www.forexbo.com/forex-market-hours, and there you can get this map in HD resolution. I'm also planning on releasing a map like this for every single time zone, so soon enough you'll be able to download this map specific to your location. And because it's in HD, unlike other Forex maps on the net, you can even use it as your desktop wallpaper. And that is very handy to always have it in front of your eyes so you can quickly reference in which Forex market session you are currently trading. On that note, I'll wrap up today's tutorial. When you do visit me on forexbo.com, don't forget to subscribe to the newsletter so that you can get access to more free tools like this and other tips and tricks. I look forward to seeing you next time, and until then, happy trading.